Good day, fellow investors. This was a nice comment here saying how I'm always bearish. I'm not bearish, I'm market agnostic, and in this video I'll explain what does that mean. So yes, we have discussed some stocks or the market recently. The risks are there: debt, inflation, crazy valuations and investing, the debt risks piling, more specifically expensive oil stocks related to the current oil prices and the outlook there. But we also have stocks to buy depending on what's your relevant risk and reward. But value investing is about what can go wrong, and that's the core. Focus first on risk and then find investments where even if things go wrong, you do well. And in this environment, I'm still fully invested. Every penny that I have for the stock market is invested. Thus, if I'm fully invested, I'm definitely not bearish. I am market agnostic, which means I don't care what the market does, because my returns come from elsewhere. And that is what I want to discuss in this video. So let's start with the core of value investing, the risk and reward, and first focus on the risk, and let's explain the risk of the market. So let's discuss the current risk and reward of the stock market, S&P 500, and you'll see I'm not bearish. I'm not here to predict stock market crashes, even if that gets a lot of views on YouTube. I'm just here to discuss the risks, and then you see how it fits you. If we look at the dividend yield of the S&P 500, let's say you have a 2 million portfolio, then the dividend is 24,000 or 26,000. And let's say that the dividend grows at 6% per year, then in 20 years you have 76,000 on your 2 million portfolio. That's a 7.6% dividend yield in 20 years. With no recessions, with no crashes, with everything great, that's nothing. That maybe beats inflation in the next 10-20 years. Which means you still will not have much money from the S&P 500 in 20 years on a yearly basis. That's the reward. Whether the S&P 500 will be at 4, 5, 6 million, I don't care. I'm not looking at the market to give me returns. Let's look at the risk. So for a small return, if the dividend yield required just halves, so goes from 1.2 to 2.6, that's a 50% crash of the market. Nobody's even talking about historical averages of 4.2, which is a 75% crash in the market. That is the risk. I have no idea whether the market will crash or not. I'm just looking at little rewards and high risk. That's it. No predictions. I don't care about the market. But then again, I'm fully invested. And here we have our quadrant. So I own in the diversified portfolio ADM. I have bought Aker. I have some Nutrient bought a little bit earlier, so on a better price. And so I already have 3 here that I show you on YouTube of the, I think it's 16, 17 position in the diversified portfolio. But then I also have other stocks that I don't discuss on YouTube, and this is the quadrant for my research platform. And you can see here ADM, this is much more conservative than the YouTube one. ADM is here, 8-9% long-term low risk. We have discussed Aker, there is some risk due to oil prices. Nutrient is here, higher risk, lower return as the price went higher. And then you have here, I'm always conservative, maybe my top position should be, let's say, here, close to 15%, whatever happens with lower risk, and you have other good plays here. So as long as I can find 10 to 15% investments with low risk, estimated on a conservative basis, I will be fully invested because I'm market agnostic. And that means that I get my returns from business ownership, not stocks going up or stocks always go up like the market does. We have discussed the risks here. This is the yield of the S&P 500, too little for me, 1.29%. But let's compare it to the, let's say, best idea I have discussed on YouTube now, which is Archer Daniel Midlands, but also Aker fits there. And then if we look at the dividend yield there, 4.23% is much better than 1.29. S&P 500, 6% growth dividend per year. Archer Daniel Midlands has been growing the dividend 10% over the last decade. Maybe the food environment will be slow over the next years, but that's how the cycles go. So sometimes the dividend will go 10% up per year, sometimes 4%. Let's take an average of 6% in line with the S&P 500. If I compare the two investments, going back to our 2 million portfolio that we discussed at the beginning, in 20 years the S&P 500 will give me 7.6. ADM will give me a yield of 27.5%. I don't know where will these stocks go. I know that stocks will go up and down. Even ADM goes up, I will sell it, because that is what happens with the food cycle. You have these booms, you have these busts when it is time to buy. The main message is that we look at business ownership, how the business rewards us. In this case, ADM, dividends, growth, protection from inflation, because we are discussing food. And that is what we do, and we cannot predict the markets. I'm not here to predict the markets. If your investment returns are based on stocks going up and your financial goals are based on markets, then you are in trouble because you are not looking at the risks of what can go wrong. And that's especially the situation in this market because of the last 40 great years that the market has shown. That's how it usually goes in finance. I'm not here to predict. I'm just going to stay away, discuss the risk and reward, and for those who are interested in value investing, I am here, my research platform is here. Thanks for watching, I'll see you in the next video.